Today we have the pleasure of talking to Mike Smolinski, President of Energy Directions and President of NAPIA. Mike, welcome to Oil and Gas 360.
Well, thank you. Great to be here.
Well, Mike, let's start off. Why don't you tell us, our audience just a little bit about your history, how you got involved in the business and that sort of thing.
My energy career started in 1969 when I was hired by the General Electric Company. I was a mechanical engineer out of Michigan State and became a power generation sales engineer for GE, selling power plants, selling nuclear, steam turbines, gas turbines, nuclear reload fuel to utilities and architect engineers. I was hired in a boom, but the first OPEC price shock put us into a bust. And we went from trying to keep up with demand for power plants to hanging on to them. And I left GE and went to MIT Sloan School and got the finance degree. And from there went to work for Data Resources Incorporated, the largest economic forecasting firm in the world. And I became an expert in forecasting energy prices. And what that really meant was I had my head handed to me many, many times.
E&P decision makers are based in a mindset where the price of oil is going to return to $50 or above sometime soon, or producers reformatting their operations and their thinking towards lower dollar oil over a longer term. What do you think?
I definitely think there's a bias. Last year, the bias was to $60 and above. I personally was looking for a V-shaped recovery. I think right now we've got a $35 and lower, a lower longer bias. And I think this bias of lower longer is going to be as wrong as last year's bias. What we see is oil prices are moving all the time. And what they're really doing is they're signaling the need for crude oil in particular to flow. Should it flow faster? Should it flow slower? And we're at the seasonal trough in worldwide oil demand with the winter coming down from a big, strong summer. And therefore, the demand for oil has been minimized. But at the same time, we're not getting the discipline of managing production, managing it the way it was done in the 1800s, the way the Texas Railroad Commission did it beginning in the 1930s, and the way OPEC has done it for most of the time the last 20 years.
Let's say if oil stays below 30 or around 30 for a couple of years, how do U.S. E&Ps make their companies profitable at that price range?
Well, what we'll see is the industry working at $30 oil, but the owners will be those who have embedded costs at, say, $20 or below. So will it be the people who have put in so much time and effort and still currently own the property, or will it be the people who will take over these resources? But the resources are there, and so we're going to see the industry work. We also have to remember that the U.S. and Canada have really accounted for all the increase in production since 2005 in the world. And the U.S. and Canada can't keep growing, can't provide that additional oil that the world wants at $30 or below. It's just not enough revenue to do all the work that needs to be done to produce these wells, and particularly to offset depletion and increase production.
Well, but what are these drilling and pressure pumpers and equipment providers? How are they going to survive this if rig counts stay low?
Well, the equipment and the people are going to survive. The question is how many. And here again, it has to do with who owns the assets, who owns the resources. Will it continue to be those people who have put all the time and effort, or will we indeed have lower, longer, and all of a sudden it'll be new players who take it over because they own the debt, or new players because they come in and buy on the cheap? To me, we needed a drilling bust. We had a drilling boom. We definitely needed that, or we'd still be above $120 a barrel. That drilling boom worked so well that we needed a drilling bust. We've now had the bust. And from this seasonal low, we need another drilling boom, but that'll keep everything that's working today working. Okay, first off, there's a perception that there's too much oil, particularly there is too much crude oil at the moment, but that growth will continue. There will continue to be too much for another year, possibly 2 more years. And what we really see when you look at all the detail is growth. The supply has already shrunk. So at this time last year, U.S. production, it was increasing at a rate of about 1.2 million barrels a day year over year. And when we look at the latest data, U.S. production isn't increasing at all. It's essentially the same as it was a year ago. So we've already seen a drop in production growth of 1.2 million barrels a day simply in the United States. Also, while we have U.S. crude oil inventory up in record high territory, inventory growth now is much slower than last year. When you look at how many barrels were in inventory December 11th and how many barrels in the latest data, and then you compare that to last year, inventory last year was growing 600,000 barrels a day per day faster than it is right now. So there's already a shrinking of the supply. Now, I'm also expecting much better energy demand, much better oil demand growth than everybody else I can find. I'm looking for oil demand to grow 2.6 million barrels a day this year, up from 1.8. You have to remember that oil is the world's major transportation fuel. It used to be the major heating fuel. So back decades ago, demand peaked in the winter. But it now peaks in the summertime because more people in the world are getting vehicles and using them at the Northern Hemisphere summer peak. And with the summer demand getting bigger, there's a much bigger seasonal drop to this winter trough. And what we're seeing with the drop in oil prices, absent discipline, is people are lowering their expectations of what economic growth is. They're not recognizing this is a seasonal drop that's going to be followed by an even greater seasonal increase. We have to also remember that oil has a tremendously high value. So the retail price of gasoline today from AAA, it's $1.83 a gallon. That's $77 a barrel. Japan's up at $3.86 a gallon, $162 a barrel. Germany's $4.96 a gallon, $208 a barrel. And Greece and the UK, they're both at $5.53, $232 a barrel. That first OPEC price shock of 73, it was motivated by the exporters claiming their resources were being stolen. They're being ripped off. When you compare what consumers are paying for gasoline because it's worth it, that gasoline demand, it's there and it's going to now grow seasonally bigger than it's ever grown.